If you own silver, I need you to stop whatever you are doing right now, because in the next 18 hours, three completely separate forces are going to converge on the same market simultaneously. Any one of them alone could move silver $3 to $5 in either direction before Tuesday morning. All three together, hitting at the same time, at the start of the same trading week. This is the most compressed multivariable setup silver has faced in this entire cycle. I am not going to tell you which direction silver moves. Nobody can tell you that with certainty right now, and anyone who says they can is selling something. What I'm going to do is walk you through each of the three forces precisely, show you exactly what each one does to silver's price mechanically, and then give you the specific levels and data points to watch so that when Monday's Asian session opens tonight, you are not reading about it the next morning. You are watching it live. Every number I give you today is public and verifiable. Links to all sources are in the description. Section 1. The three forces, what they are and why this weekend is different. Before I go deep on each one, let me give you the quick overview so you understand why these three things converging in the same 18-hour window matters. Force number 1, the Houthis. On February 28th, in response to the 2026 Iran war, the Houthis threatened to escalate the conflict and resume attacks in the Red Sea. As of this weekend, hostilities have not resumed, but there is reportedly internal debate inside the group over its response. J.P. Morgan. That internal debate has a deadline, and the deadline is not next week, it is tonight. Force number 2, the Comex delivery machine. Comex registered silver has declined 20.7% over the past 30 days, with 21.3 million ounces withdrawn. Coverage ratio stands at 14.4%. Paper leverage is elevated at 6.9 times, significantly more paper claims than deliverable metal. At the current withdrawal pace, registered silver would be exhausted in approximately 80 trading days. Bullion Vault Monday morning CME delivery report is the first data point of the new week. It tells you whether the March delivery process is accelerating or stabilizing. Force number 3, the Federal Reserve. 9 days from today, on March 18th, the FOMC meets and is widely expected to continue to pause rates at the March 17 to 18 FOMC meeting. But Fed watchers do not expect a unanimous vote. FX Empire. The positioning going into that meeting starts moving tonight, and what happened this week? The NFP minus 92,000 jobs shock, the Iran war entering day 9, the Warsh nomination stalled in Senate committee, all of it gets repriced in the Asian session before New York opens Monday. Three forces, one 18-hour window. Let's build each one from the ground up. Section 2, force number 1, the Houthis. What tonight's decision actually means. I need to give you precise context on the Houthi situation, because the casual coverage is getting the stakes wrong. This is not just about a rebel group in Yemen. This is about whether the global supply chain shock currently centered on Hormuz gets a second front tonight. The Houthis had effectively paused large-scale maritime attacks in mid-November 2025, following a regional de-escalation linked to a Gaza ceasefire. From approximately November 11, 2025 until late February 2026, there were no sustained confirmed missile or drone attacks against merchant vessels attributable to the group. This weekend's statements mark the end of roughly 3.5 months of relative calm. Fortune 3.5 months of quiet. Now ending. Here's the specific mechanical threat. The Baltic and International Maritime Council, BIMCO, the world's largest international shipping association, warned that vessels with business links to U.S. or Israeli interests are likely to face elevated risk if Houthi attacks resume. BIMCO stated that war risk premiums are likely to increase sharply if attacks resume. During previous Houthi campaigns, additional war risk premiums for Red Sea transits rose significantly, in some cases adding hundreds of thousands of dollars to individual voyages. Fortune. And then this specific warning, insurance rates are expected to increase many-fold, and ships with business connections to US or Israel approaching the area are probably not going to be able to get insurance. One India. No insurance. Same situation as Hormuz. That is the scenario that doubles the global supply chain shock. Right now you have one choke point, Hormuz, at near zero commercial traffic because insurers removed coverage. The Red Sea and Bab el-Mandeb Strait is the second choke point. The Red Sea and Bab el-Mandeb Strait remain critical arteries for global trade, linking European and Mediterranean markets with Asia via the Suez Canal. Roughly 10 to 15% of global seaborne trade transits the corridor in normal conditions. During the previous Houthi campaign, major container lines and tanker operators rerouted vessels around southern Africa, adding approximately 10 to 14 days to voyages, and significantly increasing fuel costs and emissions. Fortune. Hormuz handles 20% of global oil. The Red Sea corridor handles 10 to 15% of global seaborne trade, both closed simultaneously. That is not a supply shock. That is a supply system failure at a scale the modern global economy has never experienced. In past rounds of Israel-Iran and U.S.-Israel-Iran confrontations in 2024 to 2025, the Houthis showed up militarily for Iran through solidarity strikes. Although they have thus far limited their broader engagement to protest mobilization and political solidarity with the Iranian regime without formally joining the current war, the Houthis will almost certainly do so soon, unless they make a strategic choice to abandon their backer altogether. The Sunday Guardian. The Stimson Center, one of the most credible geopolitical research institutions in Washington, published that analysis this week. Almost certainly join soon. That is not fringe commentary. That is institutional analysis from researchers who have been tracking this group for years. The Houthis' decision to resume missile and drone attacks on Red Sea shipping in Israel shatters peace efforts and threatens global trade. The Houthis' expanded military operations will broaden the geographic scope of confrontations across the Red Sea, the Gulf of Aden, and the Bab el-Mandeb Strait. Lead Finance. What does Houthi Red Sea resumption mean for silver specifically? Maersk, the world's second largest container line, reported a $153 million loss in its ocean division for Q4 2025 as it navigated the difficult transition between Cape diversions and Suez transits. The company issued wide 2026 guidance ranging from a $1.5 billion loss to a $1.0 billion profit, reflecting deep uncertainty around the pace of any sustained Red Sea reopening. One India Global Shipping rerouted around the Cape of Good Hope. Every silver shipment from Asian refiners to Western buyers gets 10 to 14 days longer and hundreds of thousands of dollars more expensive per voyage. Physical silver supply chains that were already strained by Hormuz become doubly strained when the alternative route also closes. The physical premium story that has driven silver's structural bid for 5 years gets a new acute catalyst on top of a chronic structural problem. Watch for any confirmed Houthi strike report tonight. The first confirmed maritime attack in the Red Sea since November 2025 will move silver immediately in the Asian session. No confirmed attack overnight means the decision is still pending and the pressure is still building. Section 3. Force number 2. The Comex delivery machine. What Monday morning's report reveals. The second force hits not with a bang, but with a number. Specifically, the CME delivery report published Monday afternoon. But the Asian session tonight starts pricing the expectation of that number before it even drops. Let me give you the current state of the Comex delivery process so you understand what Monday's data point actually measures. The March 2026 Comex silver delivery started with 10,526 contracts representing 52.63 million ounces standing for delivery against registered inventory of approximately 86.13 million ounces. This occurred immediately after February 2026 delivered 5,036 contracts totaling 25.18 million ounces, the highest February delivery volume in modern Comex history. Yahoo Finance Comex registered inventory has fallen from 240 million ounces in April 2020 to 86.13 million ounces in February 2026, a 64.1% decline. Shanghai inventory has dropped from 559 tons in November 2025 to 318.5 tons in February 2026, a 43% decline. The combined Comex and Shanghai drawdown represents approximately 161 million ounces over 6 years. Yahoo Finance. Both the Western and Eastern exchange vaults draining simultaneously. There is no arbitrage escape route. You cannot move metal from Shanghai to cover Comex obligations when Shanghai is draining at the same rate. Paper leverage is elevated at 6.9 times, significantly more paper claims than deliverable metal. At the current withdrawal pace, registered silver would be exhausted in approximately 80 trading days. Bullion Vault 80 trading days from today is approximately the end of July 2026. That is when the May and July delivery months hit on a vault that is already running at 14.4% coverage ratio. The March delivery process is not the end of this story. It is the beginning of a sequence that runs through the entire year. Now here's the specific thing to watch Monday. The CME daily delivery report drops after 3 p.m. Eastern each trading day. Monday's report shows you how many of the original 10,526 contracts that stood for March delivery on first notice day are still standing versus how many rolled forward, took cash premiums, or settled through EFP arrangements. Registered metal is seeing major outflows. Since September, there has been a massive drawdown in registered supplies. This is further evidence of strain in the physical market. Investors are taking delivery and moving it out of the vault. Intellectia Dei. When investors take delivery and physically remove metal from Comex vaults rather than simply transferring the warehouse receipt, that is the strongest possible signal of physical demand. It means the new owner does not trust the paper receipt. They want the metal in their own facility. That behavior has been accelerating. The bear case on the Comex story, which I want to give you fairly, is that delivery data and vault drain statistics are frequently misrepresented. When delivery occurs on the Comex, physical silver does not typically move. A delivery is a transfer of a warehouse receipt. essentially a warrant of ownership. The silver stays in the vault unless the new owner decides to withdraw it. That same warrant can change hands multiple times without a single ounce leaving the warehouse. FX Street. That is accurate and important. The paper delivery number and the actual metal outflow number are different data points. Watch both Monday. A high delivery number combined with actual vault outflows is the maximum stress signal. A high delivery number with metal staying in the vault is more benign. The CME delivery report is free. The link is in the description. Pull it yourself Monday afternoon at 3 p.m. Eastern. That is the data. Section 4, force number 3, the Fed. 9 days to the most important FOMC meeting of 2026. The third force is the slowest moving of the three, but in some ways the most consequential because it affects not just Monday but the next 6 months of silver price action. 9 days from today, March 18th, the Federal Open Market Committee meets and announces its rate decision, and this particular FOMC meeting is unlike any in recent memory because it is happening simultaneously with 4 separate extraordinary conditions. Condition 1, weak U.S. jobs data. Rising oil prices and Iran war tensions are reshaping trader bets on Federal Reserve interest rate cuts in 2026. The FOMC is widely expected to continue to pause rates at the March 17 to 18 FOMC meeting, but Fed watchers do not expect a unanimous vote. FX Empire. That last sentence, not a unanimous vote, that is new. In January, the committee voted 10-2 to hold interest rates steady at 3.50 to 3.75%. Investing.com. 2 dissenters in January, potentially more in March, given the NFP minus 92,000 shock last Friday. A split Fed vote on March 18th is not a nothing event. It signals the internal fracture in the institution and gives markets license to price aggressive rate cuts faster than the committee's consensus suggests. Condition 2. 2 named Fed voting members are now publicly divided on the rate path specifically because of the Iran war. Fed Governor Neel Kashkari, speaking at a Bloomberg-hosted event this week, said that before the war he had projected 1 rate cut in 2026, suggesting that was no longer his expectation. Hammack said cuts could be on hold for quite some time. However, John Williams reaffirmed he anticipated at least 1 rate cut in 2026. FX Street. 3 named FOMC members, 3 different positions. Kashkari moving hawkish because of the war. Hammack calling for an extended hold. Williams staying with the 1-cut baseline. The committee is fractured along a war inflation versus labor market recession fault line. That fracture is what Powell walks into on March 18th. Condition 3. The March 18 FOMC meeting will serve as a final barometer of the Powell era. The true direction of the economy will be determined by the confirmation battle in Washington and Warsh's eventual assumption of the chair. The potential for a leadership vacuum if Powell departs before Warsh is confirmed is a tail risk that could spark significant volatility in May. U.S. Bureau of Labor Statistics. A leadership vacuum at the Federal Reserve in May 2026. That is not a scenario the market has priced. If Senator Tillis's hold on the Warsh nomination is still in place on May 15th when Powell's term expires and no replacement is confirmed, the Fed operates under an interim structure that has never been tested in a war economy. That uncertainty is a structural bid for silver that exists regardless of what the paper price does day to day. Condition 4, the dot plot. Investors will be looking for any signs of Warsh-proofing in the Fed's dot plot. Attempts by the current board to set a course that the incoming chair cannot easily dismantle. U.S. Bureau of Labor Statistics. The dot plot is the Fed's published projections for where each member expects interest rates to go. If Powell's final dot plot before leaving shows 2 or 3 cuts in 2026 and Warsh comes in wanting to reverse that guidance, silver gets a volatility event at every subsequent FOMC meeting through the end of the year. The uncertainty itself is priced by silver through the safe haven premium. The positioning for March 18th begins tonight. Watch the CME FedWatch tool as the Asian session opens. If July rate cut odds move above 65% overnight, the market is pricing the labor market recession story from NFP minus $92,000 as dominating the oil inflation story from the Iran war. That is the silver bull scenario. If July odds drop below 50%, the market is pricing the war inflation story as dominating the labor market story. That is the silver headwind scenario through mid-March. Section 5. Why all 3 forces converging in the same window matters. Here is the thing about 3 separate forces hitting the same market simultaneously. They do not add, they multiply. The Houthi decision tonight does not happen in isolation. It happens against the backdrop of a Comex vault already running at 14.4% coverage ratio and an FOMC meeting 9 days away. If the Houthis resume Red Sea attacks tonight and silver spikes in the Asian session, that spike hits a market that already has Comex delivery stress building underneath it. Physical buyers who were waiting for a pullback get repriced. The institutional investors who were watching Comex stress data see the Asian session move as confirmation and accelerate their positioning ahead of the March 18th FOMC. The momentum feeds itself. Conversely, if the Houthis stand down tonight and silver sells off, that sell-off happens against the same Comex stress backdrop. Physical buyers who genuinely want metal at $82 to $85 because the structural story is unchanged step into the paper price weakness. The vault drain continues regardless of the paper price. The delivery pressure continues regardless of what the Houthis decide. This is the asymmetry that matters. The upside scenario requires all three forces to align bullishly. The downside scenario is limited by physical buyers who see the structural story as intact at any price below $90 and will absorb paper weakness. That is not a prediction. That is a structural observation about how silver's physical market has behaved throughout this entire cycle. Global silver supply has been in persistent deficit for 5 consecutive years, with the 2026 shortfall projected to approach 200 million ounces. Industrial demand driven by solar panels, electric vehicles, 5G infrastructure, AI hardware, and medical applications is growing far faster than mine output. Alan Chand. None of those structural facts changed over the weekend, not one of them. The three forces converging tonight are acute catalysts layered on top of a chronic structural story that has been building for 5 years. Section 6, the bear case. What keeps silver below $85 through Tuesday? I always give you both sides. Here's the honest version of the case against silver moving higher this week. The Houthis stand down. Internal debate inside the group resolves toward restraint. The Red Sea threat evaporates. Safe haven demand drops. The Hormuz situation shows diplomatic progress as Iran's secret CIA contact leaked by the New York Times over the weekend moves toward actual back-channel negotiations. Fed Governor Moran told Fox Business this week he still feels rates could fall a full percentage point this year through 4 rate cuts, ideally sooner rather than later. FX Empire. If the dovish Fed faction wins the internal debate before March 18th and signals cuts are coming, dollar weakness benefits silver, but a surprise ceasefire simultaneously would remove the safe haven bid faster than the dovish Fed adds to the industrial demand recovery bid. The Comex bear case is that the bullish case doesn't require chaos. It requires repricing, and repricing can happen slowly, over months, without the vault drama that the default narrative implies. FX Street, a slow, orderly repricing of silver from $84 to $95 over 3 months is the maximum bullish case the bears will concede. It is not the explosive move that the three-force convergence scenario implies. And the macro bear case. Some top Fed officials say the annual rate of inflation is still too high to support cutting rates in the short term at 2.9%, exceeding the Fed's 2% target for the 5th straight year. FX Empire sticky inflation plus a war-driven oil shock keeps the Fed frozen. A frozen Fed with sticky inflation and no rate cuts is a dollar-supportive scenario, and a strong dollar is silver's mechanical headwind. The bear case is coherent. It requires the geopolitical situation to de-escalate faster than the Comex stress builds. The data will tell you which force is winning. That is what the watch list in the next section gives you. Section 7, your complete watch list for tonight and Monday, all free, all public. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on a paid service, that is a scam. You find me here on YouTube and on X. Data drops on X the moment it breaks. Tonight, Houthi Watch. Follow Reuters, Al Jazeera, and G-Captain for any confirmed maritime strike report in the Red Sea, or Bab el-Mandeb. G-Captain is the most reliable maritime news source for real-time shipping incident reports. The first confirmed strike ends the 3.5-month pause and changes the insurance picture for the Red Sea immediately. Link in the description. Tonight, DXY and Silver Spot. Watch the dollar index in the Asian session from approximately 11 p.m. to 3 a.m. Eastern. The Tokyo and Hong Kong sessions are where institutional Asian buyers set their overnight positioning. Silver holding above $84 in the Asian session with the dollar flat or weakening is the base case confirmation. Silver breaking below $82 in Asia means the paper market is pricing in a positive geopolitical development before you wake up Monday morning. Tonight, CME FedWatch, updated in real time. Watch July rate, cut odds. Above 65% is the market pricing in NFP minus 92,000 as the dominant story. Below 50% is the market pricing in Iran war inflation as the dominant story. That ratio tonight tells you which narrative the institutional money is positioning for ahead of the March 18th FOMC. Monday, 3 p.m. Eastern. CME delivery report. Published by CME Group at this link in the description. Watch 2 things simultaneously. The total number of March contracts still standing for delivery versus the week 1 expectation of approximately 50% resolution, and the actual metal outflows from registered inventory. Delivery reports combined with vault outflows is the strongest physical stress signal available. Monday throughout the day, silver technical levels. $80-50 is your structural floor. A break below 80.50 on sustained volume above 50,000 contracts per hour is a technical breakdown signal that the bear case is gaining real momentum. On the upside, 87.50 is the first resistance. A clean break above 87.50 in Monday's New York session on the back of Houthi confirmation or a dovish Fed repricing is the signal that the three-force convergence is resolving bullishly. Monday and throughout the week. Comex registered inventory daily update at CME Group website. Watch whether registered silver stays above 80 million ounces through the first week of March delivery processing. A drop below 80 million in the first 5 trading days of March delivery would represent physical stress that the paper price has not yet fully incorporated. Senate Banking Committee. Any announcement of a Warsh confirmation hearing date or a resolution to the Tillis hold changes the Fed uncertainty timeline significantly. A confirmed Warsh hearing date before May 15th means the leadership vacuum tail risk is being managed. No hearing date by mid-April means May 15th approaches with genuine uncertainty about who runs the Fed. Section 8. The honest conclusion. Here is the complete picture as of Sunday evening, March 9th, 2026. Silver at approximately 84.37 per ounce. Steady, holding the range that the CME 36% margin hike created on Thursday after the Asian session flush. Houthis in internal debate over whether to resume Red Sea attacks since February 28th. No confirmed maritime strike as of this evening. 3.5 months of relative calm officially ended by this weekend's threat signals. JP Morgan Comex registered silver down 20.7% in 30 days. 21.3 million ounces withdrawn. Coverage ratio at 14.4%. Paper leverage at 6.9 times. 80 trading days to exhaustion at current drain rate. 10,526 contracts standing for March delivery against 86 million ounces registered. Bullion Vault Fed FOMC meeting March 17 to 18. No unanimous vote expected. Kashkari shifted hawkish due to war. Hammock calling for extended hold. Williams staying with one cut baseline. 97% probability of rate hold at March meeting. FX Empire. Warsh nomination stalled in Senate committee due to Tillis hold. Powell term expires May 15th. Leadership vacuum risk if confirmation is not complete. March 18th meeting described as final barometer of the Powell era. U.S. Bureau of Labor Statistics, 3 forces. The Houthi decision, which could close the second global maritime chokepoint tonight. The Comex delivery machine, which posts its first week of March data Monday afternoon. And the Fed, which begins its final positioning cycle into the most consequential FOMC meeting of 2026, 9 days from now. 2 scenarios for Tuesday morning. Scenario 1. Houthis stand down or delay. Red Sea threat remains theoretical. Comex. Monday delivery report shows managed roll process underway with delivery demand stabilizing. Asian session dollar stable. Silver opens Tuesday between $83 and $86. The three-force convergence dissipates without the catalyst moment. The structural story continues building slowly under the paper price. Scenario 2. Houthis resume Red Sea attacks overnight. Second choke point activates. Comex Monday delivery report shows accelerating drain with actual metal outflows. Asian session reprices rate cut expectations as war escalation compounds with NFP minus 92,000. Silver opens Tuesday above $88, testing $90 resistance. The three-force convergence produces the sharp move that the setup has been building toward since Thursday's margin hike flush. The structural story is unchanged. 6th consecutive year of supply deficit. Comex vault at 64% below 2020 levels. Both the Western and Eastern exchange vaults draining simultaneously. Industrial demand from solar, EVs, AI hardware, and 5G growing faster than mine output. China's export licensing system still active. Iran war still running. Fed still frozen. Warsh nomination still stalled. What tonight and Monday add to that structural story is timing. 3 acute catalysts hitting an already structurally stressed market in the same 18-hour window. The structure determines the direction. The catalysts determine when. Watch the Houthi reports tonight. Pull the Comex delivery report Monday at 3 p.m. Check the registered inventory Tuesday morning. The data will tell the story. Your job is to actually look at it. Invest with logic, not hype. Protect your capital. 3 forces in 18 hours is not noise. It is the market telling you that something structural is resolving in real time. Drop 3 forces in the comments if you are watching the Asian session open tonight and plan to be up for Monday's delivery report.